Welcome, everyone. My name is Siwing Yi, and my co-host is Richard Advani, who is the country's leading investment loan advisor. Welcome, Richard.
Thank you.
The headline for the Housing Wire: When will the Fed moves alleviate the lock-in effect? Realtor.com senior economist Ralph McLaughlin said anyone hoping the lock-in effect will be busted this year may be sorely disappointed. The Federal Reserve Chairman Jerome Powell, on his recent Fed meeting just happened a couple of days ago, Wednesday, he said that the U.S. housing situation is a quote unquote a complicated one, and that quote bringing inflation down is the best thing officials can do to help. Cooling inflation will eventually allow the Fed to cut rates and alleviate the current lock-in effect, but this process will take longer than previously estimated. Quick comment, Richard, what were your thoughts on this?
Most people are experiencing just that right now, right? No one wants to sell their homes because we all have 2 to 3% rates. Payments would double or triple, and it's making it very hard for the new home buyers to come in because there's no inventory available. And as we both know, these rates are going to stay where they are for quite a while.
Exactly. Good point. And also, during the meeting, Jerome Powell said the Federal Open Market Committee, ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. Powell added that there will be a national housing shortage as there was before the pandemic, and the distortions that we see with lock-in effects. Further, he said, referring to the current situation in which homeowners holding historically low rate mortgages aren't feeling incentivized to sell their homes, reducing the number of properties available in the market. And also the FHFA research paper published in March of this year shows that nearly all 50 million active mortgages have fixed rates, and most have interest rate far below prevailing market rates, creating a disincentivized to sell. The paper suggests that the homeowner with a 4% rate, closer to the pandemic era level of 2 to 4%, is more than 50% less likely to sell with the mortgage rate at 7% than they were at 4%. The mortgage news daily, the rate is right below 7%. It's a psychological barrier. Also on Wednesday, as expected, the Fed maintained its short-term policy interest rate between 5.25 and 5.5. And only one rate cut is expected this year compared to a majority who were planning for a total of 3 cuts in March. So that's despite the lowest annual inflation record since early 2021. Now, Richard, since you are in the mortgage loan business, what the audience need to know, what does this mean? Short-term policy interest rate between 5.25 and 5.5. Is that the 10-year treasury? Please expand on it.
The 5.25 and 5.5 they're referring to is the actual Fed rate, the prime rate. And obviously what they're indicating is there's not a big drop plan for this year. And as we discussed in the past, Fannie Mae also releases their housing guidance. And Fannie Mae economists think by the end of next year that 30-year fixed primary home rates will reach 6.6 to 6.7. And that's by the end of 25. That's only 0.75% less than today. And that's our best case scenario through the end of next year. As the Fed continues to reiterate, inflation's still not where they want it. The economy is still going strong. So rates are going to stay high, unfortunately, until things slow down.
Yep, that's right, Richard. You and I talked about it before many times on our weekly podcast. People, especially real estate investors, who continue to wait on the sidelines, continue to wait for a much lower mortgage rate, they are in for a rude awakening. They're going to be waiting for a long time, and the real estate investment world will pass them by, and they will, in the future, by continuing sitting on the sideline, they will, years later, they can say, I wish I could have, should have, would have. Same old vicious cycle. You and I know that. You are in a loan business. I'm in a real estate consulting business for a long time. I'm sure you agree that human behavior is very easy to predict. Everything's based on fear. Everything is based on like the herd mentality. Everybody's a follower. Everybody is following something, waiting when a signal tells people to invest. By that time, it's too late. Human behavior is such that we have a nation of followers. Whether you are an investor or whether you're a primary homeowner, people scared to take the plunge. People do not want to lead. There are no leaders out there. Consumers out there, investors out there, most of them are not leaders. They are followers. They are followers for a signal. They are timing the market, which you and I know, because you and I have been in business for so long, timing the market will never succeed. That's a historical truth. And there's nothing you can say to refute. The median federal funds rate at the end of 2024 is expected to be 5.1% compared to 4.6% in March. For 2025, projections went from 3.9% in March to 4.1% in June. So it means, quote, once it starts, this cutting cycle is likely to be shorter than past cycles, according to Mortgage Banker Association MBA Chief Economist Mike Fratantoni. Any quick comment on what was mentioned here?
Just as reiterating what we just talked about as well, which is there's not a big drop coming in the next year or two. And look, when I got into this business almost 20 years ago, 6.5 was the average rate. If you can get in the high fives, you were getting a smoking deal. And I think that is going to be where things are going to end up for the foreseeable future, right? Once they drop, they're going to drop initially into the sixes. It'll probably hold there for a year or two, and maybe we get in the fives. The threes and fours and twos, that was a glitch in the matrix. And obviously, whoever took advantage of it, we are excited. But as the first article, it was this article said too, we locked up the housing market though, because none of us want to sell.
Exactly. Good point. Okay. Next, Freddie Mac's latest index released yesterday, Thursday, showed that the mortgage rate are 6.95%, according to the Housing Wire Mortgage Rates Center. Further, mortgage rates trends are not likely to bust the mortgage rate inventory lock in effect until at least the end of the year, and possibly well into 2025, as the Fed holds fast on fighting inflation. According to McLaughlin, chief economist McLaughlin from Realtor.com, he said the 10-year yield has to drop by 150 to 200 basis points for homeowners to feel comfortable selling and buying another home. So, Richard, what he mean? I don't know what it means, but what does it mean by the 10-year yield must drop by 150 to 200 basis points? What does it equate to in terms of the mortgage rate dropped based on this?
I think what they're referring to is probably they're talking about rates needing to drop 1.5+% to get people feel comfortable to sell their home and take a higher rate, right? Regardless, anyone that sells a home that they purchased in the last 3 to 5 years is going to have to take a higher rate. The tolerable amount of that higher rate is probably going to be in that 5% range, which is quite a bit lower than where we are today. And that's why it's saying we may be locked into the market we're in for the foreseeable future until either rates drop or more inventory hits the market in terms of new builds and stuff.
Yeah, my takeaway from this comment, 150 to 200 basis points, 100 basis points equals 1% drop. So the mortgage rate are patterned after the 10-year yield. And so 150 to 1 basis point, if today's rate is 7%, 150 is a 7% minus 1.5, we're talking like what, 5.5% mortgage rate? If it's 200 basis point, we're talking 5% mortgage rate, from 7 to 5%. Is my calculation correct?
Yes, roughly.
Yeah. You and I, in the next couple of years, we're not going to see the mortgage rate. We're not going to see 10-year yield drop by this much to 5.5% to 5.5%. If you were to drop to this low in 2 or 3 or 4 years from now, what's going to happen? It's going to unleash demand, and then it put pressure on existing home inventory and will put pressure on home prices, perhaps skyrocketing again. So I don't know about you. I do not want mortgage rate to drop to 5.5 to 5%. I know you in the mortgage business, you want it because you get more transactions, but if the mortgage rate drop by 150, 200 basis points, we're talking 5.5 to 5% 30-year fixed rate mortgage. I mean, that'll create another pandemic housing boom, multiple offers and bidding wars, which we saw in a historic year of 2021.
In the medium to long term, getting to that mid 5% range would be healthy for the housing market. But I do agree with you. It happens too fast. It is going to push another kind of boom. There's major pent up demand, even more than before. There's low supply. It's going to move down slowly, maybe 0.75%. We'll get into the sixes, mid sixes by the end of this year, moving into next year. And then a year and a half after that, I think getting to the mid fives would once again be great for affordability and also be a healthy interest rate for the market.
Yep. All right. Okay. The final paragraph, which I highlighted on yellow, is just that according to McLaughlin, he says, for now, the market pricing is just one rate cut by the end of this year, 2024, and perhaps 2 to 3 rate cuts in 2025, next year. As such, anyone hoping the lock-in effect will be busted this year may be sorely disappointed. And also, when we look at the Redfin articles or Realtor.com or Altos Research, these 3 main media research firms, that they talk about year over year, what the pending sales, what's the current sales, all the transactions they're going through in week over week, whatever. The people who are selling right now are people that are ignoring their low mortgage rate, perhaps. They are selling because they have some life issues, such as people divorcing, people passing away, people retiring, people who have or go through some medical situation, they have a disability, they can't work, they have no income coming. Those are stressed. People moving to another state as well for work, right? And to relocate to another, maybe a cheaper market, cheaper housing market for better affordability. Or people, they have forming families, right? People have one more children, their current house is too small, and they have no choice but to walk away from the lock-in effect that they're experiencing, because that's how it is. And finally, what we're looking for is the market equilibrium with housing prices cuts and softness in housing prices. So the takeaway from this article, people who are selling, like I just said, there's a very motivating reason to sell. But moving forward, the housing market, based on current situation, we're looking for stabilization. We're looking for equilibrium, if you will. Some markets have some housing correction, like Austin, Texas, and parts of Florida, and see other metros. But for the most part, the pricing housing market has been appreciating according to core logic as well. Year over year appreciation of homes are around 3 to 5%. And Redfin also reported housing appreciation this past year. So no housing crash for sure, and slight correction. Now we see some stabilization. So what you take away from this particular?
Buy real estate and wait. Don't wait to buy real estate. If you've been waiting and you're waiting through the pandemic and you're still waiting, it's not going to get any better if you wait. Clearly, the only people who are selling, as we just heard, are the people that have to sell because of a major life event. And there's not enough major life events happening for everyone out there that wants to buy a home to buy a home, right? If anything, if you still can't afford a primary home, don't wait to buy real estate, right? Go and buy an investment property, buy a 2 or 3 or 4 unit property, buy a primary investment property, house hack, do something, because waiting for the market to turn around and the opportunity to come jump in front of you to buy a home, it's not going to happen, right? So I would say get prepared to buy a home, re-enter the market now if you're out of the market, because as rates drop, there's going to be so many people entering the market. Either that or start building a tiny home, because if you're not going to buy now, it's only going to get more and more competitive out there.
I totally agree with your very good recap. And anyway, as we conclude, if you see any value in this video whatsoever, please like and subscribe and comment below. And I'm trying to grow my YouTube channel. And finally, if you have a chance, please put your email into my website below on our description, so you can become a free member of my real estate investment community. We have several thousand members, free members. So we have daily, weekly video newsletters will drop into your email inbox, so you can learn about real estate investing, a part of our investment community. So who knows, in the future, you could build up your real estate investment strategies and achieve generational wealth. Thank you so much for watching. Have a nice day. Hello, everyone. Welcome back. Thank you so much. And today is Yi, my co-host Richard Advani, an investment loan agent. So we're going to go over the potential banking crisis and how that may affect the economy and real estate investing, what have you, so forth and so on. So let me share my screen and let's go over the headline, which I obtained from this Financial Advisor magazine. And the author of the article is Laura Benitez. And the headline is Pinnacle Warns of More Regional Bank Failures on Property Real Estate Pain. So what do you mean by that? So let's discuss this. Let's take a deep dive. This company, Pacific Investment Management Company, expects more regional bank failures in the U.S. because of a very high concentration of troubled commercial real estate loans on their books. The real wave of distress is just starting. Wow. Tip of the iceberg, is that what we hear? For lenders to everything from malls, shopping malls to offices, says John Murray, Pinnacle's head of global private commercial real estate team. Further, where high borrowing costs have hammered valuations and triggered defaults, leaving lenders stuck with assets that are tough to sell. However, larger banks have been disposing of some of their higher quality assets first to avoid deeper losses, according to Murray. As stressed loans grow due to maturities, however, we expect that banks will start selling these more challenging loans to reduce their troubled loan exposures, Murray said. Adding his team has been snapping up commercial real estate loans offloaded by some large U.S. banks for the past 18 months. The turmoil has been particularly felt among regional banks, smaller banks, which boosted their commercial real estate exposure. That, in many cases, is now worth only a fraction of their value at the peak we made around 2021, right? So smaller, fraction of their value. Wow, we see some major happening, major stress. Smaller banks have continued to worry investors ever since the collapse of a few of them last year. Naming Silicon Valley Bank is one of them, but there's another one I forgot what's the name that went bankrupt a couple of years ago. So anyway, regional banks were also the only lenders that didn't demand extra down payments. So those regional banks are taking a risk 2 years ago. They did not underwrite their loans properly. They took too much risk. They didn't take enough down payment from the borrowers out there, and now they're paying for it. So anyway, let me see what else. But the borrower's failure to repay means they are lending even less compared to 2021 and 2022. Okay, what's your takeaway so far from this first paragraph, Richard?
Well, I mean, it's just what's happening in the commercial real estate market obviously is insane right now. You know, the amount of investors out there and also institutions that took out loans on commercial real estate that didn't have fixed rates and are maturing now. and their inability to refinance those loans, not only into similar rates, but into anything that's even feasible, keeps diminishing. And the problem is, even if and when the banks take possession of these properties, they're still stuck in the same position. What are they going to do with it? Because the market doesn't support even close to what they're into these assets for, once again, because rates are high. And as we know, commercial property sale prices are generally multiples of the income they generate. And if rates are higher, they generate less income, they're worth less, which means they don't appraise for enough when it comes time to refinance this short-term debt. And the article alludes to the fact that a lot of these short-term and regional banks sound like they got a little greedy, right? They started essentially giving out loans that they shouldn't have. And now that the market's turned, it's coming to bite them in the butt.
Richard, let me ask you this. Now, if some smaller regional banks will fall for the next few years, you think normally on a historical basis, the FDIC, they come to the rescue. They don't want the few banks to fall and not being rescued by the FDIC. Otherwise, the initial small bank failure will venture into the other banks, and then the consumers out there, economies out there, everybody gonna get freaked out like it happened back in 2008 housing crash. So you think the FDIC will want to prevent even the smaller banks from total bank failure and not come to the rescue? Because not coming to the rescue can really impact the consumer psyche out there. So what are your thoughts?
Yeah, I'm sure they'll come to the rescue like they always have done. What will happen though is if there are additional bank failures, a lot of people are going to put money in treasury bonds looking for safety and security and pull money out of the banks, which means that mortgage rates will drop because the yields will drop on the treasury bonds as well. We saw that happen last year with the collapse of SVB, a huge or downward rally in that treasury bond immediately thereafter, and some rate relief as well.
Yeah, exactly. Yeah, that's right. That's right. And yeah, I live in some area, so I'm very much aware. A couple of years ago, when Silicon Valley Bank failed, and all those people were trying to get their money out. All these Silicon Valley investors, they have millions of assets on this bank, and you can see on the news, on the news, those people are stressed out trying to recoup their whatever money they have from those banks. Anyway, so I would say a couple of things we need to conclude. Who's a major player in the commercial lending, and they have a 59 million property trust. They saw an uptick in withdrawal requests from my stressed out investors. Lending volumes for major public REITs, real estate investment trusts, have plunged 70% from 2021, according to Murray. So the REITs are risk investment trusts where people, where thousands of mutual fund investors invest in a mutual fund that specializes in real estate investment trusts, fractional ownership, right? It's very 100% passive. You're a fractional owner of a mutual fund that invests in real estate. So it's a package investment. So the REITs asset class, REIT asset class, have plunged since the peak in 2021. See, that's why when you investors, you do not control your money. If you think a passive investment is a good thing because you don't have to get involved in the day-to-day management, that's risk involved in mutual funds that are owned by real estate investment trusts. And this is an indication that asset class are not doing well. If you invest some money in a REIT, be prepared to bear the consequences of your investments. So let's conclude this. I know you're very busy. So while banks tend to hog most of the headlines, another area that needs close attention is the more than 200 billion of loans made by debt funds in the U.S. that are set to mature through 2025 for the next 18 months, at least, Murray said. Many of these loans were originally during the peak pricing era of 2021, often with a 3-year term and a 3-year rate cap. Okay, let me finish this up and now I'll get your final comments. So the first catalyst for stress at the asset level is occurring right now, which is June 2024 as we recording this video. So our assets will struggle to meet extension tests in this higher rate environment, Murray said. So final comment here before you make your do your recap. The combination of rising rates plus recessionary pressures creates real challenges for commercial real estate from both a capital markets and fundamental perspectives, Murray said. As we conclude, Richard, what is your takeaway from this article?
Obviously, not a good position to be in right now for commercial real estate and people that invested in these REITs. What I see happening is all these commercial lenders with that much money coming due, they're gonna have to extend terms and they're gonna have to work with these property owners because 200 billion in defaults right now would crush the lender, would crush the capital markets as it relates to these types of loans. Does that mean there's gonna be government intervention too? I wouldn't be surprised. It's happened in the past. But if these lenders do foreclose and do push through on these property owners for these loans coming due, it's going to be their demise as well, right? The lenders as well. I see them propping it up. I see them working with the property owners to restructure debt. That way they can make it through this, and that way the lender can make it through this as well. But it's going to be very interesting to see what happens in the next 6 months or so.
Okay, like here's my takeaway. Thank you. Very good comment, Richard. My takeaway is, what about that there? Okay, the potential losers are the one invest in this high-risk commercial lending scenarios. What about the potential winners? People waiting on the sidelines. Not me. I'm not going to venture into real estate default purchasing in next 2 years, but you and I, we have our own buybacks. I'm totally focusing on turnkey cash flow properties, invest for the long term. So I'm not going to wait in the sideline. Some of my, I don't talk to my individual investors that much, but a couple of my investors, they keep telling me, I am waiting in the sideline. I'm waiting for the commercial sector to crash so I could go in there and buy 50 to 80% discount. When people say this, when mom and pop investors say these kind of things, when I hear this from my mom and pop investor, my takeaway is they have no idea what they're waiting for. What if they're going to move in? How are they going to capture the distressed asset? They have to go into a syndication, along with other investors to package the money to buy the so-called distressed asset. What's the minimum investment? 100 grand, 200 grand, 300 grand to get in? Do you have to be an accredited investor? So when somebody tells me I'm waiting on sideline for the next 2, 3, 4, 5 years until the commercial loan collapse so I can swoop in and buy those loans at a discount and so I can become wealthy. So they don't know their buybacks. These small individual investors that you and I work with, they don't know what they are saying when they're waiting on the sideline and not investing in the regular low-risk income property that you and I promote. So what do you take away on those people?
Obviously, it's comical. People who don't even own a single investment property talking about waiting on the sidelines to purchase commercial real estate as their strategy. I think you and I both know how that goes. These people will still be on the sidelines 5 years, 8 years, 10 years from now, and will always follow the logic of, oh, I missed it. I missed it this time. I'm going to wait a little longer.
Yeah, I agree. Okay, Richard, you got to go. You're a very busy man. You do a lot of different things. Professional race car driver. You are investment lender. Run a good business. You're multitasking, so in a good way. So thank you, Richard Advani, an investment loan agent that we worked together for many years. So this is Siri Yi. If you are, again, as I conclude, if you see any value from this video, please like and subscribe and comment on my video. And also put your email into our inbox on our website. Log in and become a free investor insider. Thank you so much for attending. Have a nice day. I'll see you next time. Bye-bye.